All right, welcome everybody to today's webinar. As I said recently, the market is probably going to keep grinding higher, and we keep grinding. So until something changes here, I think this is what we can expect. Now, we're going to keep utilizing the techniques that are in the program, in the course. And as you can see across the board, we've been still sticking with the diagonal trades. And one of the reasons for the diagonal trade is that as the stocks move through time, we have opportunities to continue to manage the risk, bring in premium, lower the cost, increase the probability of making a decent profit. We're never going to shoot the lights out. The reason why I've been staying away from the credit spreads and the trades like iron condors is that because the market is grinding higher, you could see on any given day a sudden increase in volatility. And if you go through the charts, you know that what's been happening is every once in a while we've had a meltdown or a melt up. And then things get quiet and then they start moving again. So the diagonal spread will give us opportunities to look at individual stocks and play off of that volatility instead of having the extreme short gamma of these credit spreads. The credit spreads also have the same expiration day. So what are you going to do if something starts moving against you? There's really not much you can do. Okay? So you know that we could count on one hand over the last few months, July, August, September, the 3 months that we've been doing this, you can count on one hand the spreads that we've done. We did the IBB credit spread. And again, this is all for educational purposes. This is not specific. These are not specific recommendations, but they are used to show you and teach you how to go from looking at a chart to developing an option strategy and following that strategy and managing that strategy. So these aren't to be taken as specific recommendations because that's not what we do in this course. We're teaching you how options work, how they behave, and how to watch them so that you can learn more and more about what behaviors to expect when you put on a trade. So anyway, what have we done? We did the IBB. We had the IBB credit put spread. We sold it out of the money. It expired worthless. We had the eBay spread, the bull call spread, the 36.38 spread, that the stock actually was going in our direction, then it really collapsed. We paid, I think it was 86 cents for a $2 spread. Would have worked out great if we had held it on for the entire period, but when the stock started coming back, we actually got out of it. We sold it for $1, so we made a little bit of money, but the stock actually ended up closing above 38. And then we had that Amazon out of the money put credit spread, which it was a $5 spread. It was way out of the money. It's about 30 points out of the money. We collected $1.15 for it. Stock looked like it was moving up, and it was moving up. And then it started acting very poorly as the market was moving higher. And what we decided to do was buy the spread back for $1.10, which was a good move because the stock eventually collapsed. It has since recovered. But that spread actually went to $5. So that would have been a big, big loser. Okay? So not really working on the verticals that much because, especially on the short side, because of the short gamma and with the fact that on any day anything could happen. we've been sticking with these diagonals. Okay, so let me just show you. This would be a great example of why doing credit spreads could be a little troublesome, right? So coming up on your screen right now is going to be Priceline. And if we look at Priceline in here, let's let it set up, and we zoom in here, look at these moves. How big is that move off the bottom right there? Right there. That's that's a 35 to 37 point range for the day. How about this move right here? This one right here. That is 40 points between the high and the low. How about this one? That's a $51 move. Okay? These distances, these stocks can move very, very quickly in a very short period of time. So that's why we haven't really been doing that. What we've been focusing on instead are the diagonal spreads. Now, in a diagonal spread, you still have some of that similar type of exposure because we're buying a longer term option and we're selling a shorter term option. So we do have some short gamma. We do have positive theta, just like in a credit spread. But unlike in the credit spread, because the expirations are separated, we have a chance to collect additional premium. And even if we're not collecting additional premium, we can always roll our options and move our options around to try to massage the position so that we end up with something that actually makes a lot of sense. And it lets us withstand the volatility if it were to appear, right? Because if we've collected premium all along the way while the stock, let's say in one case, is going down, I'll show you this. I say this specifically in TripAdvisor. We can actually help ourselves and actually end up with a very favorable trade where we actually can make some decent money. And again, what we're doing here in the class is we're trying to show you strategies and management of those strategies where you can put yourself in a situation where the chances of you making consistent money go way, way up. Obviously, every once in a while, you're going to have a dud. But every once in a while, we're going to have one that's just going to work out perfectly. So if you take out, like they do in the Olympics, if you throw out the high and the low, and then you take the average, multiply by the difficulty of the dive, you actually get the final score, right? So yes, we're going to have a couple of outliers here and there. The outliers that are very high returns, we're going to feel great about, and the outliers that have lousy returns, also known as big losses, they won't happen that often on either end, but they will, and we'll just have to take them in stride, okay? So let's take a look at this TripAdvisor trade right here, which is down here. And as you can see, right now, we're long the October 40 call at $3.50, and we're short this week's 50 call, this week's 42 call for 50 cents for what looks like a current net debit of $2.90. Now, the stock is 43.40, so the 42 call is pretty far in the money. You can see it's now trading at $1.40 because we only have 2 days left. The option is $1.40 in the money, and there's only about 10 cents of extrinsic value left. So if you look at this, the current value of this trade right now is only about $2.20. So relative to the 290 debit that you see right here, this 220 actually looks like a loser. But lo and behold, it is not a losing trade. Why is it not a losing trade? Because we did start off with the October 40 call for 340. That's the option we started with. However, this was not the option we started with when we started the trade on August 29th. On August 29th, we sold the September 1st 42 call for 50 cents. So we did start with a cost of $2.90. However, we rolled that option on the 1st. We rolled that short option on the 8th. We rolled it on the 15th. We rolled it on the 22nd. And because the option we rolled to on September 22nd was the September 29 42 call that expired worthless, on Monday, that's when we sold the October 6 42 call for 50 cents. So when you add up all the money that we collected from August 29th until October 2nd, we actually took the cost of the trade down from $2.90 all the way down to $1.60. So now with the trade at $2.20, we actually have a 60-cent profit on that trade. Now, a lot of you guys say, oh, 60 cents, what the heck is that? What good is that? Right? Well, yes, it is to me a little bit less than we like. We like to be in the 25 to 30% return on initial capital. And our initial capital was $2.90. And right now, since we're only up about 60 cents, we only have maybe close to a 20% return on our invested capital. That excludes commission. However, the long option by itself is only worth $3.70. So the call by itself is only giving you a 30-cent profit. Now, let's take a look at this chart and let's follow the chart and make a note of where we did each and every one of these of the trades as we manage this position. Okay, so I'm going to put this back up. I'm going to move this over if I can. Let's see. How am I going to move this over? Right this way. Should pull right. Hello. Let's see. There we go. Come on, move over. There we go. And let's put TripAdvisor in here. TRIP. Okay. And you'll notice that it did move in sympathy with Priceline recently here. Okay. So let's see what we can do here. Let's expand this. Whoop, we don't want to go too far. Okay, where did we start the trade? We started the trade on August 29th, which is right there. Okay, that's right there. Okay, why do we like that spot? Well, we like that spot because the stock was moving up above its moving averages. It spiked up, it pulled back, hit the 21-day exponential moving average, came back up. What else was happening? Stochastics were high. MACD histogram, good. DMI, positive. The green was above the red. Okay, and interestingly enough, something called the stochastic RSI, which is a stochastic measurement of the RSI. So it's a bound oscillator. Okay, that was also showing some improvement. Right here was coming off this low. Okay, so right over here. So what did we do here? This is when we did the first trade. So let's see if I can get this little thing up here. Here we go. Where's my little drawing tool here? There it is. No, I don't want a horizontal line. I don't want that. What's this? I don't want that either. I just want to draw a line. Can't I just draw a line? Here it is, right here. Okay, so we'll do a little trend line. We'll do it as a trend line. Okay, so here's where we started. Okay, right there. And then on September 1st, so we got the 29th, the 30th, the 31st, and the 1st. Okay, right there. So right over there, that's where, that's not working out. Hang on a second, get rid of that. Erase that. Okay, let's just, okay, so here's August 29th, and let's move this across until we get to September 1st. And there's Friday, September 1st. So that first option that we sold only had 3 days left to its expiration. Now, that 50 cents was very, very attractive to us. Okay, now the stock moved up. So what did we do? Because the stock closed at 42.74, it was 74 cents in the money. We really couldn't roll to the 42.5 call and collect any premium. It actually would have cost us money. Okay, so we didn't want to do that, right? The stock was kind of stalling over there on Friday. So all we did was we moved it out to the 42 for the next week, and we collected another 25 cents. So we got our cost down to $2.65. Well, what happened? The stock kept going up. And when we got to September 8th, which I'll show you, there's Friday, September 8th, the stock was 45 bucks. Okay, so now what are we going to do? Well, we can't roll up again because we're going to have a debit, right? This is one of the things about the diagonal spreads, right? We were really right on the stock, but because it's a hedge trade, our expectations will have to be a little tempered. So what did we do? We rolled out again. We rolled out to the 42 calls again. We brought in another 20 cents, and now our cost is down to $2.45. Okay? Now, what we're hoping at this point is that the stock does run out of gas a little bit, at least consolidate up at this area. Because if it keeps going, we could end up owning a $2 spread, the 40.42, for $2.45, and that would not be good, right? That's, taking chicken salad and turning it back into, the other stuff. And we don't want to do that. Okay? Well, fortunately, the stock started going back down, and on September 15th, let's see where that is, which was the next opportunity, because it was a Friday. We try to take these out to Friday. So here's the Friday right here. This was absolutely gorgeous because the stock came right back to the 21-day moving average. It closed at 43.93, and we were able to roll to the 42 call for September 22nd for another 25 cents. So now we're down to 220. Okay, so now we're really in good shape, because now with the stock at 43.93, there's likely to be enough extrinsic value left in the October 40 that if the September 15 42 call expires worthless, or just kind of if the stock stays right around here, now we should be able to have a profitable trade. Okay, well, September 22nd comes along, and where are we? We're right over here. We're right back up again. Okay, now someone who is a little more aggressive on the trading might have just bought back the September 15 42 call for $1.95 and just waited to see what would happen, right? But that's an aggressive play because you're removing the hedge, right? And the point of the hedge is to protect you and manage the volatility. Okay, so all along we keep lowering our cost. On September 22nd, we lowered the cost again. This time we only took in 10 cents, unfortunately, but we're still with the 42 calls, and now we got our cost down to 210. Okay, now here's where the price line news started hitting, and the stock went all the way down. It actually had an intraday low of 40, and it now was below not only the short-term moving averages, but the long-term moving averages. Okay, so now we find ourselves in a different situation, right? But because we're short the September 29 42 calls, those calls actually expired worthless because the stock closed at $40.53. So our cost of our trade now is down to 210. I know for a fact, I remember that the 40 calls on that day were trading at $1.70. So this trade was only down 40 cents, and we still had a number of weeks to go to try to collect premium. Down 40 cents, and we still had a number of weeks to go to try to collect premium. Well, the trade that we wanted to do on the 29th, I really wasn't able to get any decent premium, so I waited until Monday, and on Monday, I sold the October 6 42 calls for 50 cents, and that now got our cost down to $1.60. Now the stock is back in gear. Okay, the stock's moving back up. But you could see, even if the stock had stayed in this area, right in here, for the next couple of weeks, we still would have been able to get our cost down. Now remember, this was $1.70. With a 40 call was $1.70 here. That 40 call, right, on that day actually moved up a little bit. And even if the stock had stopped over here at 42 and just gone sideways for the rest of the week, right, we could have sold our 40 call for at least $2, right? And we'd have a 40-cent profit. Again, not the greatest profit. You know, our percentages that we expect are a little bit higher, but this is the way it goes, right? We got a stock that was nice and steady going up. Then it was nice and steadily going back down, back up, right? Starting to get into a nice groove here where we're continuing to lower our cost basis on the trade. And then all of a sudden, boom. Okay, well, I'll tell you one thing. I'd rather have $2.10 worth of risk than $2.90 worth of risk. And where are we now? Just like I said, we have a trade that's worth $2.20. That our net exposure is only $1.60. So now we've got a 60-cent. We've got a 60-cent profit on this trade. Okay, and that is over a 20% return on the initial invested capital in a little more than a month, which is not too bad. Now, let's take a look. If we did want to roll one more time, how much are we going to get? Well, That's another 35 cents. So we could, if we wanted to tempt the fates, we could do this one more time, take out another 35 cents, get our cost down to $1.25, still have the $2 spread. So now if the stock went totally wacky to the upside and the spread shrank to $2, that $1.25 spread that we paid $1.25, that $2 spread that we paid $1.25 for would be worth $2, and we'd have a 75-cent profit, right? 75-cent profit. If the stock went all the way back down to 42, we should be in really good shape, right? Because we'll have the 42 call at 42, and we know that will be worth at least, I mean, we'll have the 40 call. That'll be worth at least $2, right, when the stock's 42, plus a little bit of time value because there's a week left, right? There's a week left. So we can make even more than 75 cents. So what we got to decide tomorrow and Friday is, depending on what the stock does in the next couple of days, do we want to take the profit for this week and just move on, or do we want to try to press this and actually try to make a little bit extra money? Now, just for the purposes of the heck of it, what if we skipped next week and we went to the expiration week? Here's a 60-cent credit, but now all we're left with is the vertical spread, which is a $2 spread where our maximum profit is $1 at 42 or higher. Okay? So we could really, if we wanted to, we could skip a week and just hope that the stock is at least 42 or higher on Friday, October 20th. Right? Just skip the next week. Just get the cost down to $1. Forget about the 35-cent credit. Let's get the 60-cent credit right now and not have to worry about next week at all. But we do have to wait it out, right? Because we have an option with 2 weeks left to expiration instead of just 1 week to expiration, so we don't have as much theta. Okay? So that is a good example of how trade using options like this in this kind of environment really, really can work out for you. Okay, so that's a great, great lesson for today, is to see this happen in real time. You really are seeing these things happening right before your very eyes. Okay. Okay, so what else we got going here? Okay, another trade that we have that's actually sort of in a similar situation is Lowe's. If you folks have been following along, okay, we started this trade back on September 12th, so let's zoom in right here. Actually, you get a sense of what we're looking at here, things we like to look for, which is why we play the waiting game. Here's a nice double bottom that the stock put in. The stock was holding above its moving averages on September 11th. You see it held, and it came back even though the stock was down for the day. On September 12th, right here, we actually picked up the November 80 call for $2.13, and we sold the September 22nd 79.5 call for 69 cents. Right there. On September 22nd, the stock was over, I think it was over here. Yeah, the stock was 78. So we actually rolled that 79.5 because it was only worth a penny. We actually rolled that to the September 29th, 79.5 for 26 cents. So we brought in a 25-cent net credit. But on the 29th, with the stock's starting to move up, and we had thought about this going in. We bought this 80 and we sold the 79.5. We knew that if the stock started moving up, we'd be able to roll our short from 79.5 to 80, and maybe even from 80 to 80.5 as the stock keeps, if the stock kept moving up. So on last Friday, we actually rolled to this Friday's 80 call, and we brought in another 20 cents. So now our net cost is 99 cents, but we have a calendar spread. We're long the 80 and we're short the 80. So we've got a little bit, we're in a little bit of a pickle here because now the stock's 81.46. And if we try to roll this, we don't want to roll it to the 80, we'd want to roll it to the 80.5. It's actually a 12-cent debit. Now, when I do the analysis, that might be worth it to me to pay 12 cents because the cost of this trade is only down to $1. And right now, the trade's worth $1.20. $1.20, that's 20 cents. That's also less than a 20% profit on our initial cost of $1.44. So you can see when we get these stocks starting to move up, when they move up too fast or they move down too fast, what happens is it shrinks the potential return. But we did do this trade on September 12th. So if I make 15 or 18% on my money in the span of only 3 weeks, I'm not going to be really that upset. But let's actually analyze this trade as a 12-cent debit, which would get our cost back up to about $1.12. So let's analyze this trade right there, okay? And we want to go to the second expiration, okay? And we want to make sure that our net cost is $1.12. So let's see. That's 213 on the long, 66 on the short. So that's what? That's $1.47. I want this to be $1.12. So I actually have to put this in as a 35-cent credit. Okay, there you go. So if I do this trade, for a 12-cent debit tomorrow morning, I raise my short strike to 80.5. And right there, next week, if the stock is exactly where it is right now, about 81.5, my profit will be about 43 bucks. Okay, 43 bucks. So at 43 bucks, I'm way above that 20%. I'm actually more like at a 30% return on my $1.44 original cost. Okay, if the stock backs off to 80.5, we're definitely looking good because we got an $80 profit. If the stock backs off below 80.5, then we can continue to roll because remember we do have the November 80 call. And if the stock starts moving up again, then obviously we got to do something, right? We have to roll again. Now, if we just stay where we are, and remember we have to adjust this now for 99 cents, not $1.47. So we actually have to add $48 of profit, right? So right now, if the stock stays right where it is, this shows a $25 loss, but we want to add that 40 some odd dollars back, right, to make up for the fact that the prices that we see do not reflect our actual cost. So right now, if the stock stays right where it is, we'll only have a $25 profit. If we do the roll and we pay the 15 cents or the 12 cents, whatever it is, and the stock stays right where it is next week, right there, we'll actually have a $43 profit. See? If we do the roll and the stock backs off to 80.5 next week, we'll have an $80 profit. If the stock backs off to 80.5 This week, where's 80.5 right there? We'll have what, a 40 cent. We'll have about a $60 profit right here. So actually, we might want to wait tomorrow and see how tomorrow plays out. The market did look a little weak this morning, but it did come back. So if we get a little pullback in here down into this 80.5 range, then maybe we'll have a chance to do a really good roll to the 80.5 call, because that 80.5, that 80 that was short is going to lose some value. Here you can see that the delta of our short is 89, but the delta of the option we want to go to is only 63. So that's a 26 delta difference. If the stock goes down $1, that spread should widen by 26 cents. Plus the fact that you got a little more theta in this one since we're short. So who knows? Maybe we could do this for 30 cents better and actually end up with a 20-cent credit. Boy, if I could do that for a 20-cent credit, I'd be really, really happy. Okay, so that's where we're at on that lows, but it is profitable. Okay, we added a trade yesterday in CRM. We bought the December 92.5 call for $5.50. We sold this Friday's 95.5 call for 50 cents. That gave us a $5 net cost. You can see right now we're up a little bit. We're up about 5%, $24.5 unrealized profit. That's because the stock has moved in such a way where we get a little improvement in the long call, but we actually have no movement in the short call. So let's go to that chart, and let me show you what that looks like, and I'll show you why we were looking at that one. Okay, so what day did we do this? What do you think? We did it on October 3rd. So where's October 3rd? Yesterday, right there. We got the move off of the moving averages with the stochastics moving up. I would have liked to have seen the MACD histogram a little stronger. RSI stochastics and DMI are both looking good. Premiums laid themselves out properly. A nice relationship. Earnings aren't until November 16th. So if we go over here and we look, we've got a December 92.5 call. We got plenty of time for that. And if we look at CRM, even if we want to get out of this by the time earnings come around, we still have this week. We have 1, 2, 3, 4, 5 more weeks of collecting premium, which, by the way, is one of the reasons that I looked at the December versus the November. Paying the additional premium for the extra week, for the extra month, didn't seem like a bad deal. Because if we're going to take this off earlier, we're not going to get as much theta decay in our extrinsic value. Okay, so, and we might actually get a little increase in implied volatility as we get closer to earnings. So anyhow, the point is that we've got this trade up for $5. Right now, we wouldn't buy any of this back yet because there's only 50 cents in the money. I'm sorry, 95.5. This is at the money, so this 50 cents is going to disappear, right? But if we did want it, we could take out another 50 cents right here. 95.5 to 95.5 would be another 50 cents, and that would get us down to a $4.50. risk. So we continue and continue to chip away here. It's going to look like the returns on the trades have gotten compressed a little bit. That's just because of some of the volatility in these stocks, and that happens sometimes. If things calm down a little bit, we'll be able to make that up. If not, we'll just take our 20-25% return over 4 or 5 weeks, and we'll go on to the next thing. One last comment. We have Costco earnings tomorrow after the bell, and for those of you that want to get a little aggressive, I do have this trade in my own account. I am long the 167.5 call for this Friday and short the 170 call. And I did that trade for, let's see, right now I'm down 38 cents. And the trade is worth, I did that trade for about 90 some odd cents, maybe a little over $1 when I did that trade. I'm down 38 cents. And the trade is, the mark on this trade is 72 cents. So I did it for about $1.10. So if you're looking for good earnings from Costco, this trade's even better than it was when I did it a couple of days ago when the stock was a little higher. Okay, anyway, that's what we got for you today. Keep going through the material, keep practicing, keep looking for trading ideas, and have a good rest of the trading week, and I'll see you on Monday.